Welcome back everyone, and in this video, we're going over the two stocks that I just bought in my high risk, high reward growth stock portfolio. This is an investment account that I created separate from my main dividend portfolio to invest directly into high growth SPACs and small cap companies. And these are the names with the potential to go 10x in only a few years, but come with a lot more risk. And so far, this portfolio has been performing extremely well, and I am up 36% overall. And all of the stocks that I own in this portfolio are currently in the green, but two of my companies have exploded as of late. If we take a look at my skills position, it is now up over 106%, and Virgin Galactic or Space is up close to 88% overall. I have discussed both of these companies in previous videos on my channel, but if we quickly take a look at their 1 month charts, we can see the incredible growth. So Skills is a mobile gaming company, and early in January 2021, they were trading at around $22 per share. But now where they sit at over $43, that is a 96% growth rate in one single month. And right now this company has huge mobile platform growth, and they are retaining a ton of gamers. And they just announced a major partnership with the NFL to help promote future esports competitions. So this new partnership with one of the largest sports organizations on the planet has sent their share price absolutely skyrocketing. And if we take a look at my second best performer, Virgin Galactic, you can see 1 month ago they were trading around $24, but as of late, they have absolutely exploded and now sit at over $54, representing a 1 month gain of 124%. So overall, both of these companies have absolutely exploded as of late, but these are not the names that I just bought. In this portfolio, I added one new position and I bought more of one existing holding that I truly believe in over the long term. But before we jump into my two new stock buys, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and sell, or any major market news or headlines. So please hit the like button, subscribe to the channel for daily videos, and we're going to jump right in to the two companies that I bought in this high growth portfolio. And a new company that I just started a position in is Switch, ticker SWCH. They currently trade around $19 per share and are up 15% over the past year. Their current market cap is $4.6 billion. And if we take a look at my portfolio, I bought 15 shares of this name and I'm up 6.6% so far. I bought them earlier in February 2021, and I'm expecting this to be a long-term growth holding. In this company, designs, builds, and operates some of the highest rated data centers on the planet. They have over 500 patents for their designs and have manifested them into the best producer of data centers. And right now, they're the only company in the world to offer a Tier 5 Platinum hyperscale data center ecosystem. And they have 4 locations across the United States to provide the most cost-effective and safe and secure data center operations. And they have some partnerships with some of the leading brands and companies on the planet, including a brand new deal with FedEx. And if we take a look at something that I believe is very impressive, is that this company operates all these high energy data centers with fully renewable energy. They are 100% powered by renewable energy sources, which is something I believe will lead this company ahead of their competition over the next few years. Most major brands are transitioning to use renewable energy, which will lead to a ton of increased costs for Switch's competitors. But this company is already 100% clean energy, and if we take a look, they have the highest rating. On a clean energy scorecard, they came in with a final grade of an A and are 100% on the Clean Energy Index. And they've received an A in all 5 grading metrics. But if we take a look, there are only 3 other companies with an A rating. And they are some of the largest names in the world, such as Apple, Facebook, and Google. And even Apple, the largest company in the world worth over $2 trillion, is still only at an 83% Clean Energy Index score. And companies like Facebook and Google are sitting at 67 and 56%. So overall, with regard to clean energy, which is the future of our power, Switch is doing a top-notch job. And if we take a look at their most recent investor presentation, we can see they currently operate 4 different data centers across the United States, spread out very well, and can attack both the West and the East Coast. And right now, they continue to grow and have huge plans for expansion of their hyperscale facilities. And taking a look at some financial metrics, we can see that their CAGR for their top line revenue over the past 5 years is at 17.4%, which is absolutely incredible. And each and every year, they continue to grow and expand and are now sitting at close to $500 million in trailing 12-month revenue. And as their total top line continues to grow, their EBITDA is expanding as well at a 15.5% annual CAGR. So you can see over $230 million of EBITDA over the full year of 2019. And overall, this company is nicely diversified and are not solely reliant on one single sector or one single company for a majority of their revenue. You can see all the revenue sources coming to this business are spread out across many major sectors of the world. And taking a look, their top 10 customers only make up 36% of their total revenue. So they are not solely reliant in one or two names for a majority of their income. They're nicely spread out into many different sectors, and as technology continues to grow, the need for high-powered data centers are only going to expand with that as well. So I started a new position in this company. I only bought 15 shares, and I'm expecting to follow it over the long term to see how they perform. And now if we move on to the second stock that I bought over the past few weeks in this smaller portfolio, I added to my Tattooed Chef position. I bought 10 more shares, so now I'm up to 20 shares overall, and the total gain on this position is at just around 9%. This is one company that I truly believe is going to grow over the long term. They operate in the frozen, plant-based food market, which is still very untapped, and as more consumers transition their spending to healthier plant-based alternatives, this market is likely to expand at a massive rate going forward. And if we take a look at their history, Tattooed Chef continues to grow at a very nice rate year over year. The company originated under a different name back in 2009, but as time goes on, they developed the brand of Tattooed Chef. It's innovative, it's eye-catching, and it's trendy, and from 2017, they have seen some huge expansion. And their 5-year CAGR is at 63%. So massive, massive expansion from Tattooed Chef over the past 5 years. And this company still has a huge market to disrupt. In 2019, the US frozen retail sales topped $55 billion. And right now, with their current product mix, that gives the market opportunity for Tattooed Chef at around $34 billion. And going forward, once they start to introduce desserts into their product mix, that adds another $12.6 billion of potential market share. So overall, a huge over $45 billion of market opportunity over the short term for this company to disrupt. And with their edgy branding, their solid packaging, the delicious food, people are expecting them to do just that. And Tattooed Chef offers a wide variety of different products in the frozen food section. They have single serve bowls, smoothie bowls, different vegetable blends, some meat alternatives, and even plant-powered pizzas. So they are really hitting every type of food model in the plant-based frozen section. They have breakfast, lunch, dinner, snacking, or even dessert options that are all plant-based for every single occasion. And having that wide variety of products being available for any type of meal is really what's going to lead to the long-term success of this brand in the marketplace. And if we take a look, this is a chart of their year-over-year product growth. So in 2017, they went public with 2 products. 2018, they got up to around 8 to 10. Then you see 2019, another mass expansion. Finally, in 2020, they had 38 different SKUs available on the market. And finally, for 2021, they're expecting to add 24 more and have a total of 62 different products. And I think that is the perfect number for this business. You have to have enough variety where it appeals to everyone, but you don't want to have too much where it makes it a logistics issue. You don't want to have like a couple products dominate your total sales. You don't want to have products that don't really sell through because that's going to hurt your retail distribution. So I think this number right here gives consumers a bunch of different options. They are attacking every meal of the day plus snacks. So I think you got to have a large amount of SKUs. I don't think they should go too many, but I think a nice diversified product mix is really going to help the brand grow over the long term. And with this brand, consumers who try one are very tempted to try a second and a third of the different available flavors. So if they offer every single type of product in 3 to 5 different varieties, I think it can really work well for this brand long term. And now if we take a look at their distribution, Tattooed Chef is already a national brand, and this company is still only worth less than $2 billion. And their branded distribution points was up 155% compared to 2019. And if we take a look at the 2020 numbers, they are in over 4,200 stores. And they are in the largest names. Walmart, Sam's Club, Costco, and Target are some main players within the United States, and to get into these large companies, these national brands, is a great positive sign for Tattooed Chef. And in total, they have 23,000 points of distribution, and going forward in 2021, they're expecting to be in 10,000 different stores with over 65,000 points of distribution. And that is just absolutely incredible. Being in over 10,000 stores across the nation really shows how diverse, how much consumers are going to be able to see your products, and can really help this company grow substantially over the next short term. And taking a look over the last 60 days of 2020, they were added to some major retailers such as 7-Eleven, Whole Foods, Smart & Vinyl, and many more. Kroger, Safeway, Publix, and all these different companies are going to be selling Tattooed Chef products throughout 2021 and beyond. And if they can continue to sell out through these major retailers, I think this company's just going to explode going higher, and that's why I added to my existing position. And taking a final look at some numbers, their total revenue quarter over quarter continues to grow, which is a great sign, and Tattooed Chef branded sales have absolutely exploded since 2019. And taking a look, revenue continues to grow each and every year, and the existing SKUs are making up a significant amount, and continuous new SKUs are only adding to their top line. And going forward, if they can hit these numbers, I believe the company will be massive and worth more than the 1.7 billion that they sit at today. So for the year 2021, they're expecting 220 million of total revenue, with a gross margin between 20 and 25%, and EBITDA around 8 to 10 million. But going forward each and every year, of course, we are expecting an expansion in their total revenue, and by 2026, so about 5 to 6 years from where we are today, they're expecting a total of 1 billion in annual revenue with an over 35% gross margin, and adjusted EBITDA is expected to be more than 20% of sales. So right now, I think this is going to allow the company and allow investors to get an accurate picture of where they're going. And I think the company gave very fair estimates. A lot of younger brands overestimate to try to drive investor confidence and give out these massive revenue expectations. But I think the growth that they're expecting year over year, and the fact that it's going to take them 3 years to go from 500 to a billion, I think is a very strong sign. They understand the amount of distribution they're going to need to hit $1 billion. They understand the amount of consumers are going to have to try their products first, which is a big point of difference. But as consumers overall in our society transition to more plant-based, healthier alternatives, I think Tattooed Chef, just the brand alone, can be worth a couple $1 billion down the road. And one thing I really like about the plant-based food alternatives right now is because Tattooed Chef in particular is frozen based. So what that means is it doesn't take a long time to cook. They're fast, they're easy to do, and for younger millennials and Gen Zs like myself who don't know how to cook, who don't want to cook, and want that convenience factor because everything they do in their society comes fast, I think Tattooed Chef is going to be a great alternative compared to cooking a traditional meal. So the fact that these are going to be healthy, very eye attractive, and taste very good, I think this can really be a long-term successful brand, and that is why I added once again to my existing holding. And this is a company where it is part of the higher risk portfolio because there definitely is a ton of risk from this small cap name. But I think this is a brand that is a little bit more safer, of course, compared to the other SPACs that I hold in this overall portfolio. So thank you for watching, everyone. Those are the two companies that I just bought in my high risk, high reward portfolio. I created a new position in Switch and I added to my Tattooed Chef holdings. Some other names I own are Neo, Virgin Galactic, DMY, which is a SPAC, another SPAC, Pivotal Investment Corp as again a third SPAC, and Open Door Technologies, which is one of the companies that Chamath Palihapitiya took public, and they're disrupting the real estate sector. So a bunch of my holdings are doing very well. This is just for fun. I'm not really doing this to take it seriously. Of course, I'm going to hear people in the comments say, you're up 36% in this portfolio, but your dividend portfolio is only up 16%. So why don't you transition more of your capital to these smaller cap companies? Because clearly it is working out. But one thing I want to say about that is that with these companies, this may work out in the short term. I may be able to pick these few companies that do very well, but going forward, I do not believe I could do this at a consistent basis year over year. And although some of these companies have seen some massive growth, they are still very small and their future is still very unpredictable. So there's still a ton of risk. Some short-term price volatility and some short-term gains, unless I sell and collect that profit, nothing's for sure. All of these companies can get wiped out and go to zero very fast. But with my long-term dividend holds, that is very unlikely, and that is why I predict that this portfolio will continue to grow very well over the long term each and every year while paying me passively every quarter in dividend income. That's what I prefer to put my capital in rather than these short-term fluctuations that may come and go at any time. So I hope that explains why I still have this portfolio very small. I still will be adding a couple $100 into it every single month so we can buy more stocks, have more stuff to talk about on the channel, and watch some more smaller cap names, hopefully expand at a very fast rate. So thank you for watching, everyone. I am the Gen Z Investor, and see you in tomorrow's video.